Welcome back to the deep dive. Today we're really jumping into something fascinating, I think.
Yeah, definitely getting into the weeds of market mechanics.
Exactly. We're looking at institutional trading precision today, specifically focusing on order blocks and breaker blocks. What are they? How do they work?
And crucially, how are they different? Because they often get confused.
Right. And these aren't just, random squiggles on a chart. Our sources describe them as actual zones where institutional order flow leaves its signature.
Like fingerprints at the scene of the crime, almost.
Yeah, something like that. Or maybe breadcrumbs is a better analogy. Anyway, our mission here for you is pretty clear.
Yeah, we want to help you grasp these concepts quickly, get those aha moments, but without the usual information overload.
We're going straight to the source material, trying to distill it for you. So let's dive in. Where should we start? Maybe the basic definitions.
Sounds good. Let's lay the groundwork. What is an order block?
Okay, so an order block. Fundamentally, it's the last up-closed candle before a big down move, or the last down-closed candle before a big up move.
And that move is key, right? The displacement.
Exactly. That move has to be significant, what they call a displacement, and it needs to leave behind an imbalance. You might know it as a fair value gap or FVG.
Gotcha. So order block equals last opposing candle plus displacement plus imbalance.
That's the core formula. And it signals a change in the market state of delivery. That's the technical term.
Okay, that makes sense as a starting point. But here's a common question I hear. Are both order blocks and breaker blocks really just about these imbalances, these FVGs?
That's a great question because it hits right at the confusion point. And the answer is not quite. They're related, but different.
Okay, so how does a breaker block differ then?
So a breaker block, it's formed differently. It comes from a sequence of swing points. Think like for a bullish setup, you have a low, then a high, then a lower low.
Okay, low, high, lower, low.
Right. And price violates that middle high, breaks through it, then crucially, it reprices back into that level, that previously broken swing high.
So it breaks through a level and then comes back to test it from the other side.
Precisely. And that broken swing point becomes the breaker block, acting as new support or resistance.
Okay, so order block is about the origin before the move. Breaker block is about a broken level being revisited after a move.
You got it. And a common mistake, our sources warn, is just randomly picking highs and lows. Treating any old high or lows as a key institutional level without understanding the precise conditions and market structure shifts.
Right, it's not just any high or low. It needs that specific context, that specific sequence of events.
Exactly. The context and sequence are everything.
Okay, that clarifies the basic difference. Let's dig a bit deeper now. How exactly do these things form? Let's start with the order block again, the genesis of the move.
Right. So for a bullish order block, the rules are quite specific according to the material. It's the lowest candle or price bar with a down close that has the most range between open to close and is near a support level.
Okay, lowest down close candle, biggest range near support. That's pretty precise.
It is. And it's validation. How do you know it's actually an order block?
Good question. How is it validated?
It's validated when the high of the lowest down candle or price bar is traded through by a later formed candle or price bar. So price has to move decisively above that initial down candle.
Got it. Price action confirms it. But what about that imbalance we mentioned, the FVG?
Yes. The absolute deal breaker, or maybe deal maker here.
The sources are emphatic about this, right?
Completely. Quote, without the imbalance, there's no order block. Simple as that.
So no FVG, no order block. Why is that FVG so critical?
Because that fair value gap, the FVG, it represents inefficiency in price. It's where the market moves so fast in one direction that it didn't allow for efficient two-way trade.
Like a vacuum.
Sort of, yeah. It's formed technically between three candles. You look at the low of the first candle and the high of the third candle. If there's a gap between them around the middle candle, that's your FVG.
And the sources call these actual inefficiencies that indicate order flow?
Exactly. They're signals that the market left something unfinished, a place it's likely to, revisit to balance things out.
Makes sense. Price-seeking efficiency. So the overall purpose of an order block is?
It marks that change in the state of delivery. Think of it like the market switching gears. If it was mostly offering sell orders, a bullish OB signals a shift towards offering buy orders and vice versa. The algorithm is always hunting for liquidity.
Hunting for buy-side liquidity or sell-side liquidity. Got it. It's where the institutions likely initiated their big positions.
Precisely. Okay, let's switch gears now to the breaker block, the retest after the shift.
Right. So its formation. It comes from a broken swing point.
Yeah, exactly. It's derived from a swing point that fails, basically.
Right.
So let's take that bullish breaker example again. Low, high, lower, low. When price breaks below that first low, that lower low confirms the break-in structure. Then the high that was formed in between those two lows, that becomes the potential breaker block.
Ah, the high between the two lows.
Yeah. As ICT puts it in one source, breaker is a low, high, low, or low find in between, extending out in time. The market trades down into that. It's that specific high you watch.
Okay, that sequence is key. And you mentioned a break-in structure. This links directly to market structure shifts, or MSS, right?
Absolutely. The breaker block really comes alive after an MSS.
So what defines an MSS technically?
Well, according to the Recognizing Market Structure Shifts material, it's when price, say, breaks below a swing low, convincingly, or above a swing high for a bullish shift.
And this often happens after liquidity's been taken.
Typically, yes.
Yeah.
Often after a run on a buy stops or sell stops. It's like the market grabs the fuel liquidity and then reverses course, signaling the shift.
And the MSS helps pinpoint the precise moments price changes direction. That sounds incredibly useful.
It is, but there are rules. An MSS isn't just any break. It requires liquidity sweep first. That's critical.
Liquidity first, then the break. And it needs to be confirmed by...
Confirmed by displacement. Again, that word displacement, it can't just be a weak little poke through the level.
Right. Displacement implies force. What is displacement, really?
The displacement source defines it as an energetic move, one that clearly breaks market structure.
Yeah.
And importantly, also leaves inefficiency, FEG. So FEG is relevant here too, confirming the strength of the break.
Okay, so liquidity sweep, energetic break of structure, MSS, leaving an FEG forms the breaker.
Well, the MSS confirms the shift. The breaker block itself is that violated swing point within that context. So after the MSS happens, price might reprice back into that breaker block.
And that's the entry opportunity, the retest.
Exactly. It acts as dynamic support or resistance. The source mentions it often signals a significant turning point after a liquidity sweep. Its previous role is flipped.
And both order blocks and breaker blocks are tied to liquidity pools, right? These areas where orders cluster.
Absolutely. The identifying liquidity pools source calls them areas where buy stops or sell stops reside. They act as targets for people to hunt liquidity. The algorithm is designed to go to these zones.
Okay, this is building a really clear picture. We see how they form, their connection to imbalances and structure shifts. But let's boil it down. If you're sitting there looking at a chart, what's the fundamental difference in how you'd approach trading one versus the other?
Yeah, that's the million-dollar question, isn't it? How do you use them differently?
Exactly.
Okay, the core distinction, I think, comes down to timing relative to the big move. An order block, remember, is formed before the displacement and the imbalance.
Right, it's the origin point.
Precisely. It represents the point of origin. Or, as one source puts it, smart money accumulation or distribution before an impulsive move. It's where the move starts.
So trading an order block means you're trying to get in early.
Kind of. You're waiting for price to return to that fair value gap within the order block. You're looking to enter there, basically getting in sync with that initial institutional push, ideally at a better price.
Okay, anticipating the move continuing from its source. Now, the breaker block.
The breaker block is different. It's that violated swing point that price comes back to after the main push, after the market structure shift has already happened.
So it's more of a confirmation trade?
You could say that.
Yeah.
It acts as a retest of a broken level where its function flips. What was support might now be resistance, or vice versa. You're trading the retest after the market has shown its hand with the MSS.
So order block entering near the origin, anticipating continuation. Breaker block entering on a retest after a confirmed structure shift.
That sums it up pretty well. Both are liquidity pools, yes, targeted by the algorithm. But an order block is about getting involved with the initial move from that inefficient area. A breaker block is about using a confirmed shift and entering when that broken level gets revisited.
Different tools for different phases of market movement.
Exactly. Different stages, different setups, though both rooted in that institutional footprint.
Okay, cool. That distinction is much clearer now.
Good. All right, feeling sharp. Let's do a quick drill. True or false?
Let's do it.
Question 1. A valid order block absolutely must contain a fair value gap.
True. Definitely true. That's the key ingredient.
Correct. Question 2. A breaker block forms when price retraces to a swing point that was previously broken.
True again. It's all about that broken level being revisited.
Nicely done. Okay, final one. Are order blocks and breaker blocks just fancy names for plain old support and resistance levels?
Tempting to say yes, but based on the precision, I'm going to say false. They're much more specific.
Exactly right. False. They have very specific formation rules and context tied to institutional flow, not just any horizontal line. Great job.
Yeah, okay.
Now, even with clear definitions like these, traders still run into problems, right?
Yeah.
There are common pitfalls.
Always. Knowing the definition isn't the same as applying it correctly in real time. Context is everything.
Totally. So pitfall number one, and we've touched on this, but it bears repeating, identifying an order block without that critical fair value gap.
Right. People see the last down candle before an up move and just label it, forgetting the imbalance.
Exactly. And the source quote is unambiguous. Without the imbalance, there is no order block. Period. Got to have the FEG.
Non-negotiable. What's another common trap?
Trading against the bigger picture. The higher time frame bias.
Yes. Getting caught on the wrong side of the dominant trend.
Precisely. Both order blocks and breaker blocks work best when they align with your daily bias. If the daily chart suggests the market wants to go lower, trying to trade a bullish order block on a 5-minute chart is, well, it's fighting the current.
Yeah, low probability. As the quote goes, if the bias is bearish, would you go in looking for a bullish fair value gap? No, that's the purpose of having a model.
Exactly. Know your direction first.
And that daily bias, just to clarify for everyone, is essential for directional trading. It gives you that baseline on what the higher time frame daily chart is likely trying to do.
Right. Trading against it is a classic mistake. If the bias is bearish, would you go in looking for a bullish fair value gap? No. Makes perfect sense.
Okay, so FVG confirmation and trading with the daily bias. What else trips people up?
Timing. Ignoring the specific time of day or the kill zones.
The time windows where setups are supposed to have higher probability.
Exactly. These patterns are much more reliable when they form within specific sessions or kill zones. ICT emphasizes this. It's important to know why the kill zones are there. Kill zones are when you determine your entry and you, well, quote trails off, but the point is timing matters.
Absolutely. And the sources give us specific times, right? Like for London.
Yep. The London kill zone is typically between 2 o'clock and 4 o'clock in the morning. New York time, that's going to be your time window where the setups occur.
Okay, 2 a.m. to 4 a.m. ET. And New York.
New York kill zone is often cited as 7 a.m. to 9 a.m. New York time. These aren't random. They're periods when major liquidity often enters the market, facilitating these kinds of institutional moves.
So check for FVG, align with bias, and look for the setup during key times. That adds layers of confluence.
Exactly. It stacks the probabilities in your favor.
You know, stepping back, all these concepts, order blocks, breakers, FVGs, MSS, liquidity pools, kill zones, they all fit under this bigger umbrella, don't they? Institutional order flow or smart money concepts, SMC.
Absolutely. It's a whole framework for reading price action.
Yeah, it's about understanding the why behind the moves. Like one source says, what I'm teaching you is the internal dialogue of what we're doing. We're looking at price. We're not thinking like the collective that is commonly referred to as the retail trader. It's a different perspective.
Thinking like the algorithm almost.
Kind of, yeah. Because another core idea from the sources is that these markets are absolutely 100% scripted and controlled by an algorithm. Now, whether you take that literally or not, the point is price moves with intent and follows predictable patterns based on liquidity and efficiency.
Right. Seeing price not as random noise, but as a deliberate delivery mechanism. That changes how you approach things.
It really does.
Okay, so let's just quickly stitch that all together again. A quick recap of order blocks versus breaker blocks.
Good idea. Hit the key points.
All right. An order block. It's that final opposing candle before a sharp displacement that leaves an imbalance. FEG. It signals a change in price delivery right at the origin of the move.
Check. Origin point needs FVG.
A breaker block. This one forms after a market structure shift, MSS. It's a violated swing point. The price comes back to retest, and its roll flip support becomes resistance, or vice versa.
Check. Retest point after MSS, roll reversal.
And fundamentally, while they're both significant areas, liquidity pools targeted by the algorithm, they represent different things. Order blocks are about the initiation, breaker blocks are about the confirmation and retest after a shift.
Different stages of the same underlying algorithmic process.
Couldn't have said it better myself.
Well, hopefully this deep dive has shed some real light on order blocks and breaker blocks for you. We hope it sparked some of those aha moments.
Yeah, the goal was clarity and cutting through some of the confusion.
And as you go forward, looking at charts and thinking about these concepts, Here's a final thought we want to leave you with, something to really chew on. It comes from the source on market maker models.
Oh, yeah. What is it?
It asks you to consider, what does it really mean for how you view the market if you accept that the market is delivered on the basis of liquidity and balanced rebalance?
Delivered on liquidity and balance. That really frames everything we discussed, the FEGs needing to be filled, the runs on stops for liquidity.
Exactly. It suggests this underlying, almost mechanical process driving price. Something profound to think about, maybe.
Definitely food for thought.
And hey, if you're still wrestling with some aspect of this, or if something isn't quite clicking, let us know. Comment with your number one confusion about order blocks or breaker blocks. We genuinely want to know what you're finding tricky.
Yeah, absolutely. Thanks for joining us on the deep dive.
We'll catch you on the next one.